Welcome, ladies and gentlemen, to this webcast on IFRS 9 hedge accounting. My name is Sebastian di Paola and I chair PwC's Global Corporate Treasury Technical Committee. Joining me today are Ian Farrar, who's a partner in our Global ACS, Global Accounting Consulting Services group, and also leads our corporate treasury practice in Hong Kong and China. Welcome, Ian. And Yann Umbricht, who is our corporate treasury leader here in the UK. So as I said, we're going to be covering, giving you really the highlights of what IFRS 9's new rules are around hedge accounting. It's just one piece of the IFRS 9 journey, and I think some interesting developments for you that listeners will be keen to know about. Our focus is very much on a corporate treasury audience for this, but having said that, there'll be elements of what we're going to be talking to you about today that are also going to be of interest to financial institutions. So in terms of the areas that we're looking forward to covering on this webcast with you, we're going to talk about the timeline, first of all, around how have we got to where we are today with these changes. We're then going to talk you through the main features of what IFRS 9 now says in respect of hedge accounting. So that covers what the new qualifying criteria are. It covers what the new rules have to say about hedging instruments, some important changes around hedged items, and then we'll move on to talk a little bit about, if you're not doing hedge accounting, what are some of the alternatives, what are changes in respect of some of those alternatives, and then we'll move on to accounting policy choices and transition, and then provide you with a short summary. So with that, we'll move into our first topic, which is then our timeline for IFRS 9. So although today we're just talking to you about micro hedging, I think it's important to sort of locate this, Ian, within the broader framework of the changes that the ISB is making to the financial instruments rules. So maybe you can take us through a little bit of that history.
Sure, Sebastian. The ISB, when it developed IFRS 9, it's taken a phased approach. So in the first phase, which was completed in 2009, they issued a part of the standard relating to financial assets. They added to that in 2010 with financial liabilities, and then they've actually issued an exposure draft to make a few tweaks to those requirements around financial assets and liabilities. This is the second piece, the hedge accounting piece that we're going to talk about today. The remaining piece, the remaining phase relates to impairment, and we're hoping that that's going to be finalised in 2014. The effect, once it's all been put together, then an entity will be able to adopt it. And I think when they issued the hedge accounting piece, they did remove the effective date, but we're anticipating that it's probably going to be sometime around 2017 that it would become effective.
Okay, so our focus today within that framework is very much around the hedge accounting piece. And if we look back, actually, I mean, we did a similar webcast to this one when the standard that we're talking about today was an exposure draft, and that's actually going back 3 years now. So it's some time ago. So it's taken us a while, and I think the market's very much looking forward to being able to apply these rules. But as you say, they're not actually mandatory yet. And we'll come back to some of the accounting policy choices that we have later on. So if we move on from the timeline, the next thing we wanted to look at, if we dive into what the standard has to say, is the qualifying criteria. They've changed quite a bit. They've become certainly probably simpler than what companies have had to apply so far. Maybe Yann, you can take us through. I suppose the one that people are most familiar with is the doing away with the 80 to 125% bright line. But that's not all of it. So, Yann, if you could tell us a little bit more about that.
Yeah, absolutely. I think overall things have changed a lot with the effectiveness test, but the rest is still in there. So you still need to have documentation, you still need to have appropriate hedging relationship, you need qualifying instruments, qualifying hedged item. But the real important element that's changed is how you measure the effectiveness of your hedging relationship. So brilliant. I think a lot of our clients will be very delighted that now we've moved away from some quantification of that assessment, but the ISB has still come up with 3 key criteria to assess the effectiveness. So one is there needs to be an economic relationship between the hedging instrument and the hedged item that offsets to hedge the risk that the company is trying to hedge. That's also linked to a better alignment with the risk management approach of the company. So probably a better match of risk management to accounting results. credit risk, financial crisis has become a very significant issue, and the ISB has said that the credit risk element of the fair value should not dominate the change in value of your hedging relationship. And that's quite an important point, I think, particularly if credit continues to be very volatile in the future. And finally, the ISB has said that there needs to be a hedge ratio, and that hedge ratio has to be consistent with the quantum of the instrument you use to hedge and the quantum of the hedging item.
So a lot of that sounds, well, good news, simplification, but also much more qualitative than what we've had thus far. And in some respects, I think it's clear that we've been able to do away with that 80 to 125% bright line because we're booking in effectiveness to the P&L anyway, so it doesn't really make that much difference. But this last point that you mentioned, Yann, around the hedge ratio, I think is still going to be a little bit confusing to people because people sort of feel, well, if I'm hedging dollars with dollars, then why would I have a hedge ratio issue? I mean, Ian, is that something you can give us a little bit more colour on? And I think that's probably one of the areas where there's still a little bit of a quantitative angle here, but I guess it's quite narrow in its application, isn't it?
Sure, that's right. I mean, the requirements that Jann's explained, they aren't just a one-time test. So you need to continue to keep reassessing your economic relationships there, credit risk isn't dominating, and most importantly, the hedge ratio is still the valid one. So what the standard does is it brings in a requirement for mandatory rebalancing. So if at some point in the future it seems that your hedge ratio has changed, you're required to go and update the relationship in your hedge documentation. So to give you an example, if you're a European entity, for example, so euro functional, you have a purchase to make in Hong Kong dollars. Well, Hong Kong dollar is pegged to the US dollar, so quite often you find people might take a euro to US dollar derivative as a hedge. Because of the peg, it's good enough. Now, while it's pegged, there is actually a small trading range around the peg of 7.8, which means you will have some noise, a little bit of ineffectiveness maybe, just because of the small trading range, but generally it's going to be a good relationship. But let's assume that the government in Hong Kong decide to repeg, and let's say it gets repegged at 7.2. Well, now you've got a big shift in what would likely be your hedge ratio, and you would be required to go and update that hedge ratio in your documentation. But the really good news in all this is that, of course, under IAS 39, you probably would have wanted to rebalance anyway, but when you did, that would be deemed to be a new hedge relationship. Whereas under IFRS 9, it's actually a continuing hedge relationship, so you don't need to reset hypothetical derivatives and the like.
Right. So to some extent, this is also where our link with overall risk management comes in, because actually the hedge ratio concept and rebalancing is actually just getting you to do the right thing that you would do anyway from a risk management perspective. So that all sounds like very good news for corporates, and probably a simpler exercise then to qualify for hedge accounting in most cases. If we can then move on to our next topic, which is to look at what changes the ISB has made with respect to what are qualifying hedging instruments, and maybe Yann, you can kick us off here around probably the main change in this area.
It's the key change, but it's not a major change, I think. In the past, you could have used non-derivative financial instruments to hedge foreign currency risk. So, a piece of debt to hedge either future revenue in foreign currency or net assets. The ISB has now added that you can use non-derivative financial instruments measured at fair value through profit and loss account to hedge any other risks. And I think that comes from the fact that those financial assets, particularly measured at fair value through profit and loss, would normally have an embedded derivative in them that in the past could have been separated, and that derivative that was separated could have been used in a hedging relationship. Now, because it's not separated anymore, it's part of the financial asset at fair value through P&L, you can use the entire instruments to hedge any kind of risk you want to hedge.
Right. So I mean that's probably relatively narrow, let's say, in its application, but nonetheless an important change. The other area that's changed here is actually the mechanics of how we do the designation and some of the accounting for particular types of instruments. Ian, maybe you can tell us more about the topic of how the standard now deals with time value of options and forward points of forward contracts.
Sure. The standard IAS 39 used to allow us to use portions of hedging instruments only in very limited circumstances, and that really related to using the intrinsic value of an option and excluding the time value, and also using the spot part of a forward contract. Now they've been carried forward into the new standard. The big change though is that before, when you use the intrinsic value of an option, for example, all the time value changes used to go to profit or loss. They were not part of the hedge relationship. IFRS 9 looks at it slightly differently. It says, okay, you've got some time value here, and we're going to let you put the movement in time value, certainly for an aligned option, into OCI. So it takes it out of profit or loss. Now, there is a requirement, depending on the type of hedge. If it's a time period related hedge, you need to amortize that to profit or loss over the period of the hedge. Or if it's a transaction related hedge, you'll take it at one time when the transaction happens. So that's going to reduce a lot of the volatility that people currently see if they're hedging with options today. A similar idea is used for forwards too. So again, you can separate into a spot and a forward component. And here, while with options you must put the change in OCI, with a forward contract, the standard gives you an option. If you wish, you can still put the gains and loss in profit or loss, or alternatively, you can defer them in OCI, and again, either spread them or to put them in profit or loss when the transaction happens. One other thing that the standard brings in is the notion of currency basis, which currently, in cash flow hedges at least today, people tend to include in the hypothetical derivative. The standard is clear you're not allowed to do that because it views it that is not a part of the hedged item, so it shouldn't be reflected in the hypothetical derivative. But the good news is they say, well, you can treat the currency basis spreads as if you would with the forward points in a forward contract. So again, you can put them in OCI and amortize or bring in when the transaction happens.
So again, these all sound like pretty good news, and certainly IAS 39 previously had been criticised as being somewhat option unfriendly because of the volatility from the time value. And then we have this flexibility around how we deal with the forward points, and the ISB has heard, I think, the market's need for some sort of solution on currency basis as well, which they've provided. So again, I think we can say this is all good news for corporates. If we now move on, so that was hedging instruments. If we now move on to probably the more significant changes that they've made are around what are qualifying hedged items. Here maybe Ian, you can kick us off on what are the main qualifying hedged items that are now allowed that weren't previously.
Sure. One of the big benefits of IFRS 9 is that you can now hedge risk components in non-financial items. So in the past, if you had a financial item, such as, let's say, a 5-year floating rate bond in a foreign currency, you could hedge any piece of that you wished. The currency, the interest rate, interest in year 1, year 2, and year 3, all of it. There are many choices the way you could divide that up. For non-financial items, however, there was no such ability to do this. What you had to do, you could hedge it for all of the variability or just for FX. With IFRS 9, we now have the ability to use risk components, so slice and dice the hedged item for risks in exactly the same way as for financial items today. And we can do this as long as the item is reliably measurable and separately identifiable. So the same criteria we have today. And this is going to be really useful for people who deal with commodities, for example. So if you're trying to buy something that has a high copper content, before you would have had to have hedged the whole item. Now you can just choose the copper content of that item. So really good news. Right. We can also hedge aggregated exposures now, and by that we mean where we have an exposure that includes a derivative and a non-derivative together. In the past, we're not allowed to hedge derivatives, so that was outlawed. Now, well, we're still not allowed to hedge derivatives in most cases, but when packaged together with a non-derivative, we can now treat that as a hedged item. So, for example, let's assume that I have a foreign currency floating rate debt. I decide I'm going to hedge for interest rate risk, and only interest rate risk in the foreign currency. So I designate that as a hedge relationship. Subsequently, I decide I want to hedge currency now. What I'd like to do is hedge the package of the existing debt and the swap. In practice, I'm not allowed to do that under IAS 39 because it contains a derivative. Under IFRS 9, we're now going to be able to do that. Another piece of good news is relating to net position hedging. So let's say I have sales in a foreign currency of 100 and I have purchases of, let's say, 80. So my net position is 20, and I'll probably go to the bank and get a derivative for that 20. What I'd like to do is use that 20 as a hedge of both my sales and my purchases. IAS 39 doesn't let me do that. It says you can't aggregate things which have offsetting risks. so I can only hedge 20 of my sales, which doesn't really give me the economic answer I want, particularly if the hedged items affect profit in different periods. With IFRS 9, again, we're now entitled to hedge both the sales and the purchases on a gross basis with a net derivative, which is really good news. The slight bad news here, I guess, is that we're not allowed to put those gains and losses into sales and purchases, for example. We have to put them in a separate line in the income statement. So presentationally, not perfect, but certainly a big step forward from where we are today.
Yes, and this at least is a partial resolution to a lot of the issues that corporates have had for years now with IAS 39 around particularly Treasury Centre FX.
Exactly right, yeah. Exactly right. The last point I wanted to raise was around hedging equity instruments. Equity instruments at fair value through OCI. If you look at the current guidance, you're not allowed to hedge anything that doesn't have an impact on profit or loss, and if it's fair value through OCI, it never will. But the ISB have allowed in IFRS 9, you can now hedge equity items that won't affect profit because they're fair value through OCI.
So all four of those, and I would say probably particularly the first three, are really major changes that are going to enable us to address some of the areas where, frankly, IAS 39 was causing a misalignment with common risk management strategies. And as you said, I mean, very, very much friendlier accounting for commodity risk managers, that's clear. But also then in terms of being able to have derivatives as hedged items, it'll give companies a lot more flexibility in how they designate hedge relationships and avoid some of the problems that people have been having with derivatives with non-zero fair values going into hedge relationships.
Absolutely.
So that's all really good news. Now there's a little bit of a narrowing of what's available in terms of this topic of whether or not you're allowed to use undiscounted spot. So Yann, maybe you can tell us a little bit more about that one. That's probably not quite such good news.
Yeah, thank you for giving me the bad message to deliver. I think the one where in the past we've been pretty flexible in terms of using the spot element of a forward contract to hedge a forward currency risk that will happen in the future, where we're allowed to ignore the time value of money. So we said, if you got dollar exposure in the future and you take a dollar contract, the spot element will fully offset, and that's nice and easy. Now, the ISB has been very clear. You have to take into account time value of money and discount back to present value both the hedged item and the hedging instrument. So it's all fine if the timing is very similar or the interest rate environment of the country where you operate is low, but where you're going to have uncertainty around the timing of the hedged item and a higher type of interest rate environment, these may create a lot more ineffectiveness that we had been used in the past.
So I guess here, companies that had then been assuming that they'd done away with the problem of that timing mismatch because they were hedging just the spot element, that doesn't work anymore because we now have to discount the spot, which, yes, is going to be awkward for some. On the other hand, I suppose the fact that we don't have the effectiveness test, so it doesn't create the risk that we're going to fail, maybe makes it a little bit less of an issue, but it's certainly different than what we had before. Okay. So broadly good news on hedged items with that little twist with regard to discounting. So if that was hedge accounting, we now want to spend a couple of minutes to look at alternatives to hedge accounting. So if you're not applying hedge accounting, there are other ways to achieve some degree of natural offset. Some of those already exist today, but there's also a couple of new ones coming out with IFRS 9. So maybe Yann, you could cover the first of these for us.
Yeah, I think that one's very good news for people that uses own use contract in their risk management strategy when they include it into contracts that are already accounted at fair value or derivatives. So they look at the overall portfolio of contracts from a pure risk management point of view, of which some may be accounted at cost and some at fair value through P&L. Now, those companies have got the ability to use those own use contract and account them at fair value through P&L to actually reflect really the risk management approach that they've taken to their portfolio of commodities, for example, and reduce the exposure through their P&L. So avoiding the accounting mismatch we've seen in the past.
Right. So the sort of own use contracts we're talking about are predominantly sort of commodity sourcing or commodity supply contracts.
Even when you're going to receive or deliver the underlying commodity, you can still use that option. And it doesn't. In the past, people had to go through hedge accounting and do all the documentation, and it was quite painful when actually their net exposure, taking into all the contracts, were close to zero. Here now we say, well, you can include everything, and that's going to have minimal impact, and you don't have to go through the hedge accounting requirements.
Right, so you're creating a natural offset by sort of recording it all on a fair value basis.
Absolutely.
Yeah, okay, so that's definitely good news for companies that have, I suppose, that particular business model where they've got maybe sourcing and sales contracts that are own use, but which they hedge on a fair value basis from a risk management perspective. Okay, and then we've got another one that is more around credit risk. Maybe Ian, you can tell us a bit more about that one.
That's right. There may be companies that have a large exposure to a particular entity in terms of credit, and they maybe want to hedge that, so they take a CDS as a hedge of their exposure. What I mentioned before, we said that you can hedge risk components of financial items under existing IAS 39, and that's true. But the IASB has been clear in IFRS 9 that they don't view credit as being as meeting the criteria. In other words, it has to be reliably measurable and separately identifiable, and they don't believe it meets that criteria. So accordingly, they say, well, you can't use a CDS to hedge your credit exposure in a debt, in a receivable. So what they've done is they've introduced another option. They've said, if you have a CDS and to hedge credit in a bond, as long as the names match, it's the same reference entity, and they have the same seniority, they will allow you to designate the receivable as at fair value through profit or loss. Now you may say, well, I already have this accounting mismatch idea, I can designate already. The benefit of this option is that normally you have to designate that as an accounting mismatch at initial recognition. And once it's designated, it stays designated. Well, with this option, you actually have a bit more flexibility. So let's say subsequently you take the CDS out after initial recognition. You're then allowed to opt to designate that at fair value through a P&L. And let's say you no longer hedge, you get rid of the CDS, then you can de-designate from fair value through P&L. So it introduces more flexibility.
Right, so good news for people that are hedging credit risk, a little bit more flexibility, and I mean, it's been a thorny issue under IAS 39, so we've got at least a partial solution then to that problem. Good. So I think that covers what we wanted to talk about in terms of what the new standard says about hedge accounting, hedging instruments, hedged items, and some alternatives to hedge accounting. We should now move on to what happens in terms of the choices that companies now have to make and how they transition. Probably the first observation we can make is that obviously for companies in the EU, before we can apply any of this, we have to wait for EU endorsement anyway. So it's going to be interesting to see what comes from the EU on that topic. But there's also this point around an accounting policy choice between IAS 39 and IFRS 9 hedge accounting, which is a little bit unusual, isn't it, Yann?
Well, it's not very usual to have that type of choices, but I think that was raised by the financial institutions, particularly those that are using the macro hedging criteria from IAS 39. And they say, well, until we know what IFRS 9 on macro hedging will say, we don't necessarily want to transition first to IFRS 9, then IFRS 9 macro hedging. We may want to continue with IAS 39, waiting for the entire transition to the new IFRS 9. So there's a choice for companies to either go for IFRS 9 or continue on IAS 39. Companies that move to IFRS 9, they can also continue to use the macro hedging criteria that are within IAS 39 until IFRS 9 macro hedging has been published and issued. So in summary, IAS 39 with macro hedging or IFRS 9 with the IAS 39 macro hedging requirements can be used. It's a choice that can be made every year. So you can continue for a year on IAS 39 and then decide to move to IFRS 9, but it's a one-off choice. Once you've decided to go to IFRS 9, you continue with IFRS 9.
There's no coming back. Yeah. Right. So as you say, it is a little bit unusual, but the IASB has been quite understanding about the difficulty that people have making a decision when they don't yet know what's coming with macro hedging. Absolutely. Yeah, good. So that's in terms of ability to still retain IAS 39 hedge accounting. Ian, can you tell us a little bit more about what are the transition choices if we do then move to IFRS 9 hedge accounting?
Sure. As I said at the start, the whole IFRS 9 approach has been a phased approach. So there's been various phases along the way. And what the IASB has done, they've allowed flexibility in terms of exactly which pieces of IFRS 9 you're allowed to adopt. So you could choose, for example, just to adopt the own credit piece of IFRS 9 that was issued quite some time ago. Or you could decide, no, I actually want to do the 2009 version, which included the financial assets only. Or I can do the 2010 version, which includes assets and liabilities. Or I can say, no, I want to do the whole lot, and I want to include hedge accounting as well, and therefore take IFRS 9 complete as it is today. But of course, as IFRS 9 continues, so we're going to have amendments to classification and measurement, we're going to have impairment, those transition rules are also likely to change. So I think that companies need to think ahead and say when exactly do we want to time the adoption.
So there's some important choices to be made, and companies need to look at the impact analysis from each of the components to decide on what their transitioning strategy is then to IFRS 9. Okay, very good. So I think we've covered now also accounting policy and transition, which really brings us to the end of our webcast. But before we leave viewers, just another very quick summary of what the key points are that we've brought out today. There are now significant changes, I think we can say, from IFRS 9, which broadly speaking are to the benefit of companies, and in particular this point about enabling much greater alignment and even requiring much greater alignment with the way companies actually manage financial risk. So I think we can all agree that's good news. The removal of the 80 to 125% bright line is very much a part of that, but there are still some qualitative criteria that we need to meet to be able to achieve hedge accounting. We can expect that there will be more hedge relationships that actually qualify, or hedging strategies that qualify for hedge accounting as a result. Worth singling out then the point on risk components for non-financial items, which we talked about, which is, as we said, tremendously good news for commodity hedgers. And we know that there are many companies that do hedge commodity risk which have had a lot of issues under IAS 39 and as a result have not done hedge accounting, who are looking forward to adopt IFRS 9 to address that point. We also touched on hedging as of net positions, which is something that has been a very thorny issue for treasurers, and again we've got at least a partial solution to that here. And then the elements that we talked around some of the changes in how you account for time value of options, forward points of forward contracts and currency basis, all of which again are actually good news in terms of taking volatility out of the income statement. So broadly speaking, I think we can say this is a very good change, a good evolution in IFRS as it affects treasury functions and financial risk management. So with that, hopefully, we're sure you were all very excited to hear about this before. You're probably all the more excited now after this session. Obviously, we realise that remains very, very high level as an overview. So we would encourage viewers of this webcast to go and look at our straightaway publication. It's effectively an executive summary of the standard. That's already available on our website. We're also currently working on a practical guide which will provide detailed examples. We've done a similar one under IAS 39. We're now doing one under IFRS 9. So we will be publishing that in the near future. And with that, it remains to me to thank Yann and Ian for sharing those thoughts with us today, and to wish all of you watching today the very best of luck with your implementations. And obviously, if you have any questions, please do approach your regular PwC contact. Thank you very much.